Hey everybody, so in this video, I'm going to spend some time on inventory because I didn't with receivables because I'd already done it actually in class. So we're going to do the slideshow. I'm going to emphasize exactly sort of the areas I want you to focus on, which slides don't matter at all, and which ones are really important, and which ones should actually be a review that we did earlier. And then after I've done those key things, I'm actually going to do the first problem. I'm going to do an illustration of how I would answer it in a sort of an organized, more streamlined way than the solution set that's on our syllabus. All right. And up here, those are kind of the timelines where those things appear in case you're feeling pretty good and you just need to rush to a certain point. All right. Here we go. So with inventory, I want to make something perfectly clear up front. You might have caught on to this, but you might have missed it. Students most frequently get confused by the fact that when we change inventory valuation, so the method and the assumptions we're using, that we're somehow changing how much we actually have. We're not. Like if we have 500 pieces of chairs, so we have 500 chairs in our inventory left, then we have 500 chairs in our inventory left. Changing the assumption doesn't change how much you have. It's changing the assumption of how much those 500 chairs are worth and not retail, how much they cost you. That's what we're talking about. That's the main idea. So if you have 500 left, you have 500 left. Doesn't matter which method. But what you're saying in terms of your assumption about how much they're worth, that's what this lesson is about. So put that somewhere where it's gonna stick, because that's where people get the most confused. Okay? So what we're going to do is we're sticking with inventory, and I am going to go through this PowerPoint slide lesson a little bit, just like I used to in class back in the olden days, because I didn't get a chance to go through this one. I went through the receivables in person. I didn't go through this one. So I'm going to go through it, tell you what to focus on. All right? So first, chapter 6 from a textbook we don't have. This slide's important. Let's even view it. It kind of stands out. If this is conceptualizing that if you had beginning inventory, and to which you add down here the value, again, it's the cost to you of the goods you purchased, and you put it all together, you may not have had it all on hand at any given time. There would have been no day during the accounting period where you had it all. But at one point or another during the accounting period, you had all of this available, called the cost of goods available for sale. You've seen this calculation before in grade 11, or you should have, and we reviewed it the first week of this course. Okay? So remember, there's only two things that can happen to your inventory. Either it's gone and sold, or you still have it. And in reality, yes, it can be destroyed, it can rot, it can be stolen. But ignoring that, it either is cost now because you sold it, or you still have it. Okay? And that means that value that was on your balance sheet as inventory, right, a short-term asset, it's either still there or it's left. So as I said earlier, if you had 500 left, then all the other units that were around at one point or another, they've gone. The question is, how much are the ones in terms of cost value that you paid for? How much is left dollar-wise, and how much dollar-wise are you sending to the income statement as cost of goods sold? Because your assumption will change your profit. It'll change that cost of goods sold, and it'll change your profit. And that's really what this unit is about. Okay, so let's look. Okay. Inventory in general is important for retailers because it's often the largest asset, which means for all your ratio analysis and anything that uses asset value in them, it's important to get this ending value correct and to not miss it. Auditors come in and check inventory all the time because that's how you hide value, adjust profit, right? If you're sneaky in a dodgy company, that's why auditors come in and they check all your inventory, all the big stuff, right? Because that's the easiest place. That's the easiest way to hide or manipulate your numbers. So second, in terms of real things, inventory being the largest asset is also where you'll lose your most money if it becomes obsolete or walks out the door from being stolen, right? So it's something you have to control, right? And this next slide, I think it's the next slide. I'm going to come back to this just because I'm on this thought right here. This is review. This is what I'm talking about. This slide we can ignore, don't focus on it, but this is talking about why internal controls about inventory and paying for your suppliers to send that inventory, why it's so important. Because if you have people who work in all the different departments, they can steal money and hide it, right? If I have control over ordering, I can pretend to order something from my shell company and I got control over receiving, I can say that the fake goods arrived. And then if I have also control over payment to pay suppliers, I can authorize the check to go to that fake company, which is really my company. And if I'm also in control of accounting, I can hide it all in the books. So internal control is important, but we're not going to focus on it. So let's go back. I'm going forward. One sec. Right here. So here is an illustration of why inventory is so important and valuation can matter so much. All of these things that accountants make judgments over. Because one small change, when everything else is fixed, or called a sunk cost, and it's one small change can change revenue or cost just a wee bit, then that whole change goes straight down through the formula to net income. So check it out. Oh my God. Stupid Google. None of this is animated. 1 second. Okay, so take a good look at this slide. Because one, if you made a copy of this file earlier, it's wrong. So only filming this video did I notice how badly Google screwed it up when it converted it from PowerPoint. So watch, I'll go through it. So this slide matters because it illustrates how important, and not just in inventory, but all our topics, how whenever an accountant has to make a judgment call when it comes to the step of valuation. Remember our three most important things: acquire, adjust, which means value, and then dispose of. So when an accountant has to value something, that decision can have a big impact on profit, right? When given everything else is fixed or sunk costs or frozen or done with, one change in something else goes right through the formula, right to net income, and has a dramatic impact. So watch. So if you recall, we just looked at this slide, right? All the costs available for sale, and two things can happen. Pretend only two things can happen, right? Either you still have it, or it's gone and it's become cost of goods sold. So if you had $100 and you sent 60 as cost of goods sold to the income statement, you still have 40 in your inventory, right? And if you screw something up and you put 50 in your inventory, that means you can't still send 60. That has to add to 100. So if you have 50 now left, that means you sent 50 to the income statement. And remember, you still have 500 shares left. It's how you value them. So if you screw up in any way, it's going to have an impact on your statements, and it can be pretty dramatic. So let's go through the example. So first, if you have an old version, this arrow is pointing in the wrong direction. If for whatever reason you screw up in your ending inventory account, or because of the valuation assumption, which we'll talk about in a sec, if for whatever reason inventory now ends up lower, means you're holding back less from the income statement, right? So more value will go, not more quantity, more value, cost value will go to the income statement as cost of goods sold. So flip over here. That means cost of goods sold is higher. That'll mean gross profit is lower, which means your profit is lower. But look at the quantities. And I made this number up, totally made up, 70,000, made up. So let's say, for whatever reason, you undervalue your ending inventory by 10%. So scenario A is where you do everything perfect, and it's correct and accurate, right? You end up with $100,000 profit. If you screwed up and you had 10% more, so $70,000 of ending inventory less, so you let that 70 grand by mistake flow to the income statement as cost, it ups your cost of goods sold by 10%. And if you follow that through, everything else is the same, right? Your operating expenses are the same. You end up with, instead of $100,000, you end up with 30. The whole 70 hits profit because everything else is finished and fixed. A sunk cost, as it's called. So that's a 10% increase in your inventory cost. The cost that you send to the income statement. So in your cost of goods sold, 10% up, profit down 7 times as much at a rate 7 times bigger. That's why this stuff matters, this valuation stuff. Got it? So next slide. This is not new. This is review. We did it with revenue recognition. The only thing you have to remember on this slide is when legal title changes. So on the revenue side, if you sell goods FOB destination, you haven't earned the revenue until they arrive. So when you do an inventory account, you have to remember the same thing. That if you sold something and shipped it FOB destination, then when you go in your store and you count your inventory, don't forget about the inventory that's on the truck that's still en route, because that's still yours. Otherwise, you're going to do what we just did in the last slide, what we just talked about. You're going to screw up your ending inventory value and then screw up your profit. So remember, revenue and inventory are recorded based on your shipping status. So this was the key learning from this section, right? This topic. And it's valuation assumption. Again, it's not how much quantity you have left. It's what that value is. There are 3 assumptions. There's FIFO, LIFO, and average cost. Most firms use average cost. It's just easier, right? But FIFO is pretty popular. And internationally, LIFO is not even allowed, if I recall. It's only allowed in Canada for small firms, right? That's it. So here's what we're going to do. I'm going to quickly go through these. I think they're self-explanatory. If not, they will be when I do it. I'm going to do a demo, right, of a standard problem and how you do it. If you get it, you get it. Most students don't find this too difficult. So here goes. Okay, FIFO stands for first in, first out. So visualize. Mostly a grocery store would use this, right? So the milk comes in. It's the first to come in. You get some more milk. The oldest milk, the first that came in, is what you sell first. You're assuming that is what's happening, right? And these are called cost flow assumptions because you don't actually freaking stand around watching. Like, you don't actually know. You're just assuming that's how your goods move. And in many cases, FIFO is how goods move, especially goods that spoil. So the oldest stuff gets sold first, right? That's essentially what it means. The next one, LIFO, is the opposite. So the oldest stuff is sold first, the most recent to arrive is sold first. And it doesn't happen very often, but if you think of maybe like, say, in spring when people, do their yard work, right? Like a pile of mulch or soil, the old stuff is there. And then suppliers will come and dump the next pile on top. And then customers will come and take off the top. And that's actually the most recent stuff to arrive. That would be a situation where LIFO is actually what happens. And then average cost is you just pile it all in a big pool mathematically, figure out the total that was available, total units, total value, and you just come up with the cost per unit, per pound, per whatever. That's the difference. What really matters is the impact that has in different periods of time. That's what I want you to focus on. So take a look at this illustration. So here's prices, right? Prices are rising over time, let's say. So it's an inflationary environment. So here's time going along, prices are rising, and here's the beginning inventory at the lowest prices. And then you get some more, and then you sell it. And then you get some more that arrives, and then you sell some more. And then you get some more, and then you sell some more. And the assumption with FIFO is that the oldest stuff is sold first, so you are left with this stuff, the newest. That has a couple of implications. You are assuming you are keeping in inventory the most recent and most expensive, right? So again, if you have 100 units left, there's no question about the fact you have 100 units left. The question is about how much are they worth, right? So if prices changed over the accounting period, you're assuming you have the 100 most recent and therefore most expensive stuff. And if you recall that principle, if this is how much we had, and we're assuming we're keeping the most expensive stuff back and sending the rest of that value to the income statement as cost, FIFO, in a period of rising prices, is going to hold back and have the highest inventory value. And that's, it's not necessarily good or bad, that's just what it does. It is advantageous, though, because if you look at inventory on a balance sheet for a company that uses FIFO, that is also the value that is closest to what it's currently worth. Right? So if they had to buy another 100, it would probably be at about these prices. So the inventory valuing is actually better for FIFO when prices are rising. Right? So there's a little chart. Skip right to the end. You'll have it all done. Right? I'm going to look at it when we're done. So obviously, when prices are falling, your ending inventory is going to be the lowest of what it could be. Right? Let's look at LIFO. LIFO, when prices are rising, assumes that, again, there's this pile of mulch and the new mulch comes on top and you sell the new stuff first. So what's left in inventory is the oldest. And if prices are rising, it's therefore the cheapest stuff. Right? Average cost, and it's opposite. Since it's the oldest, so here's what you remember. LIFO keeps the newest stuff in inventory. FIFO keeps the newest stuff in inventory. LIFO keeps the oldest. That's always true. Just remember that. And then you can adjust your thinking whether prices are rising or falling. But FIFO keeps the newest stuff in inventory. LIFO keeps the oldest. And average cost is just a blend. It's average. Right? Oops. So here's the chart. So the highest ending inventory So FIFO, when prices are rising, the oldest stuff is, the most recent to arrive, right? So the newest stuff is in inventory. So it has the highest inventory value, which means it sends the most cost to the income statement. My mistake. Rewind. FIFO has the newest stuff at the highest prices, so holds back the most value. So costs going to the income statement are lowest, so profit is highest, which is what's written right here. LIFO, down here, has the oldest stuff at the lowest price. So inventory value will be smallest, sending the most cost, resulting in the lowest profit. Right? And then when prices are falling, which they almost never are, you have the opposite. And then average cost is always in between. And if prices are constant, then all the methods will be the same. Right? There'll be no difference. Does that make sense? If not, you know how to ask questions, or you should. Those are the key learnings. Okay? Now I'll go through an example. Okay, lied about the example. One more thing. And this is actually not as important in inventory. It's just important overall, because what this is called is a write-down, a lower of cost or market write-down. And it applies, it's not just in inventory, it's everywhere, all throughout the course, all throughout all valuation steps for different aspects, different assets and stuff. Okay, the concept is because of the principle of conservatism, you can't have on your balance sheet something that you for certain know is just it's not going to provide the future benefit that you've got on there, right? So if you took over a company for $1 billion and they're literally just losing money, and for whatever reason trends have moved a certain way and the products that they make are never going to be in demand ever again, you can't keep that $1 billion on your balance sheet as the value of that investment of that company and its assets. You can't. Same thing with patents, that drugs that are no longer competitive because there's better ones out there. You have to erase that value, right? So to be conservative, the rule is often the lower of cost or market for inventory. Lower of cost or market means whichever is lower, that's what it should be recorded at. So either your cost to buy it or its current market value. Remember, important part, it's already recorded at cost. So you only need to write it down, in other words, erase value, if market value is lower than your cost. Okay? So here's an example. So here we have a bunch of really old, this is an old example. It's got stuff that nobody buys anymore, right? Recorders and VHS, whatever. So if you look, here's the cost to our business of these items in inventory. And here's the current market value. There are two ways to do this. There's the total method. So you add up all the cost of every item and it comes to a grand total of here, 168. Okay, and then you add up the grand total of all the market value of those items, so what you could sell them for, and it comes to 166. So the market is 2,000 lower than cost to you, and so that will require a lower of cost or market write-down of $2,000, and it looks something like this. So it'd be like loss on write-down to lower of cost or market or some other ridiculous name, and you would credit the inventory items for 2,000. Right? The other way, which I think actually now is required under GAAPs, is item by item. So instead of going down the whole column and totaling it up, you have to look at each individual item. So for example, consoles, cost is 60, market's 55. So you got to write it down by 5. So then you put 5. And then portables, 45, 52. It's already recorded at 45, which is the lowest, so you don't have to do anything. And then same here, recorders, 48, 45, that's another 3. 15 and 14, that's another 1. So that is 5, 3, and 1 makes 9,000. So it's more conservative when you go item by item. So if you look, this is lower by 3, this is lower by 1, and that was lower by 5. That adds up to 9,000, which is what I have here. Right? So if you do it item by item and write the lower of the two, it totals 159 versus what we have right now, right? Cost is what it's at now, 168. And so then you would change this number, journal entry is the same, but you would change it to 9,000. Right? This comes up in a couple of different situations where you have to do item by item. You do it with long-term investments. You can do it with certain types of other assets, not just inventory. Got it? Okay, sample problem. Let's look at problem 4A. from this topic. I'll go through it. I know I've released the answers, solutions, I'll do it, but this solution answer key is terrible, the way they organize stuff. So I'm going to show you the way I would expect it to kind of be laid out, which is kind of like one of the practice assignments we have. So here's up there on the right, behind me, whatever, is 4A. So if you can see, there's a couple of purchases, and you see the prices aren't constant. It's a period of generally rising prices. And by year end, it tells you 750 units were sold. Here's where students make their first mistake in these types of exercises. You'll forget about beginning inventory, right? So there's 100 units already. So you have to add these. So that's 3, 5, 8, 9, plus the 100 is 1,000 units available at one time or another. That's quantity. The actual cost is going to be different. In other words, the cost of the ending inventory. Okay. It also tells you 750 units were sold right here. So 750 units sold when you had 1,000 means you have 250 left. So the issue is figuring out which 250. Okay. So what I would do is I'd have a sheet like this. This is what I'd expect you to be able to do, right? This is the key learning from the actual application side of this. Can you do the 3 different valuation methods, figure out what the effect on profit or the difference between profit would be, and then I'd be happy. Okay, so here's the thing. In terms of quantity, it's 100. That's our beginning inventory value. And they're telling us what they're worth as well on this question. They say we have 100 units left, and it cost us $20. So that would have come out from previous assumptions. So that's $2,000. So let's do our numbers. We'll just go 2,000, 2,000, 2,000. That's what we started with. Our purchases, what were they? Okay, we bought all of this stuff. What does that work out to be? So save some time in the video. I'll use the answer key that you have. This is how you calculate it. So there was a beginning inventory of 20, purchase 300. So right now we're focusing on purchases. So 300 at $24, 200 at 25, 300 at 28, and 100 at 30 equals these values, right? When you put it all together, it's going to be this value. That is the cost of the goods available for sale, right? So it's 23,600 of purchases for a total of, because we started with 2,000, right? That's our beginning inventory. So it should look like this. Net purchases, 23,600. And notice something. These first 2 things, they don't change under any of the assumptions. You know how much you spend, right? Saying how much of the value that was around is left doesn't change how much you bought. Doesn't change what you started with. So the cost of goods available for sale is this plus this under all 3 methods. It was 25,600. That was the number, right? Or was it 24,600? Where was my solutions? 25,600. Okay. A lot going on in my mind around me. Okay, so ending inventory. This is the only row that changes. Everything that changes because of this row. So if you assume the first goods that came in have been sold, then the ending inventory quantity must be composed of or comprised of the newest purchases. So let's look quick again at the question. It told you you had 100 and you bought 900 at 1,000 and you sold 750. You sold 750. Okay, so that means you have 250 left. Well, what are they? This is where you need this little thing. You need to look. Okay, so if I have 250 left, I must have, so this is the most recent, so I must have all these 100. And I must have another 150 because I have 250 left, right? 1,000 available, sold 750, leaves 250. So I must have these 100 and 150 of the next most recent, which are these. So that's 30 and 28. So you would go, ending inventory must be then 100 times $30 plus the rest, 150 times $28. So our ending inventory under this assumption is 7,200. Right? And if you have those solutions open, you can see that's what they got with this ridiculous display, this messy thing I can't even follow. I just can't, ridiculous. So 7,200. And let's skip over then to LIFO. LIFO, here's the thing. This we're trying to get across early in this video. You still have 250 left. You're not changing that. You're not saying, yeah, let's pretend we have 50. No, that's not what this is about. You have 250 left. So which 250? That's what changes. The assumption about how goods flow in your business. So that means you have This is where you'll forget the beginning inventory. You had beginning inventory. So if you have 250 left under LIFO, which is the last to come in on top, goes out first. So you're left with the oldest, then your beginning inventory is your oldest. So this 100 at 20, and then 150 more at this first oldest purchase at 24. So 150 of those. So you would go equals 100 at 20 and 150 at that first purchase, which was 24, I believe, right? Double checking again because I have no memory. Okay, right. I just got vibrated. My phone is vibrating. So let's then try to figure out what is average cost. And I can do it over here if you want, but you don't really need to. Because we have the solution key. You'd have to do it off somewhere to calculate it if you didn't have that solution key, right? What you do is you know you had 1,000 available, and we know the cost of the goods available was right above. So that's $25.60 each, right? I'll just put it in the cell for now. So it's 25, this cell here, $25,600 of goods available, and you had 1,000 units available during the accounting period. So that's $25.60 as an average cost of each. Guess what? You have 250 left still. So if that's your average cost for each item and you have 250 of them left, that is your average cost value of your inventory. Simple enough, right? So it's all the value available during the period, all the units divided by all the units available during the period for a per unit cost. And then you just multiply that per unit cost times however many units you have left. Make sense? So then the rest is not new. You should know how to do this calculation. So cost of goods sold is all that was available minus what you say your ending inventory is worth at cost value to you, right? So then that's 18,400 under FIFO, in between for average, and 20 for LIFO. And this obeys our rules, right? In our question, prices were rising. So under the method that keeps the newest stuff and therefore the most value back on the balance sheet, you have the lowest cost. For the method that keeps the oldest stuff on inventory and therefore retains the least amount of value, you've sent the most cost, 20,000, to the income statement. And then average is average. It's in between. So then if you have net sales, is there a way for us to figure that out? There is not a method to figure that out. So if we made up net sales, I'm making this up. Let's say there were 50,000. So if you had sales of 50,000 and you had cost of goods sold right here, oops, minus sign in front of that, and we just subtract that. We can copy that across. Now you can figure out gross profit. Right? And you would just then complete this. Operating expenses, they'd have to give you that. So if I'm making it up. Here we are making stuff up. Let's make it up at 10,000. That would be the same too. That doesn't change. The only thing that changes is how much your ending inventory is deemed to be valued at. That's it. So then you would just be able to complete this table. That's it. This is what I expect to be able to do. A table like this to see the difference. There is one question in this though that's important. Right here at the end, which method would have the most favorable impact on the company's cash flows? That is an interesting question. And would it matter? Would any of them? I often use that for a thinking problem. So the answer, of course, if you think about what was paid and what was received in real cash, that should help you answer. On that note, if there's any questions, you know how to ask them or find them, I hope. If not, go back and make sure you watched all the videos I sent. Work on those problems, make sure you can do something like this and that you understand those key conceptual things that we went through, we emphasized in the slideshow. Sorry this is a long video, but if you pretty well can master this, you should be able to do it in a day or two. Since I've summarized it, then we're pretty well ready to move on. All right? Good luck. Let me know if there's problems.